Stocks this morning hovering near record highs following a tech-fueled rally. Kathryn Rooney Vera of StoneX writing, the valuation math works only if earnings keep rising or Treasury yields fall. Kathryn joins us now. Well, Kathryn, which one do you think it's going to be? We do have yields a little bit lower this morning, potentially the market breathing a little bit of a sigh of relief that potentially we're at the end of the road here when it comes to conflict in Iran.
Yeah, hi. I'm not bearish. I think it's still a bull market and earnings are still growing. And that's the basis of this rally. And that's a good thing. But the market is extrapolating, I think, first quarter spectacular earnings of 28% through the year-over-year, through the rest of this year. We really do have a lot of headwinds. Equities near record highs in a time that I truly believe, Anne-Marie, the Fed tomorrow is going to be pulling the rug out from the easing bias. So when you have a Fed that's not going to cut, but I've been calling this since January, the real risk is a hike. I think that's going to happen this year. Combine that with equity risk premium, which is effectively zero versus the 10-year Treasury, then you have forward earnings yield now sitting at parity with the 10-year. So you're taking equity volatility and getting paid virtually nothing for it. So I think the rally has already front-run the earnings growth. And I think that, we're in for a very volatile rest of the year.
The earnings growth, though, has been remarkable, Kathryn. I mean, it feels like nothing can stop this, especially as we rethink sectors like semis, that maybe they're not cyclical anymore and the growth continues. Why can't we continue to get that type of earnings growth upgrade to help power this equity market forward?
Well, since the end of the first quarter, Danny, analysts have raised their expectations for S&P earnings for the rest of the year nearly 10%, and the index has risen more than that. So investors have already paid up for the stream of earnings that they're expecting. So you need to get earnings that continue to surprise the upside in the face of a market that I think is going to increasingly price in what I think is very likely going to be potentially more than one rate hike. My team member, John Hilsenrath, does a survey of former Fed officials. And out of approximately 32 of them, the overwhelming majority expect 50 basis points in rate hikes this year. There's only one former Fed official that's expecting a rate cut. So, I think that I agree with Andrew you're from Citi that, if we get a rate cut, it's only because we get unemployment moving materially higher. We're not seeing that. We're seeing unemployment remain very low. And that's coincident and supports my view, which I've held since the beginning of the year, which is that the real risk here is not stagflation. The real risk is overheating of the U.S. economy. We have multiple quarters of economic growth above potential, with a 6% fiscal deficit, with the consumer remaining remarkably strong. I think it's a long shot to call for a rate cut this year.
Kathryn, thank you so much for your time this morning. Kathryn Rooney Vera of StoneX Group.